Good afternoon and good morning, everyone, and welcome to our final webinar of the year, An Investor's Guide to 2024, Buy, Sell, Finance, and Thrive in Senior Care. As the name suggests, we have a lot to get to today, and so there's a very good chance we'll go over our hour time commitment. It could go about 10 minutes over, so to our audience, feel free to stay on for a few extra minutes afterwards. We'll especially try to address some audience questions later on in the webinar. But before we begin, just a few details. If you experience any technical difficulties with today's webinar, you can contact Irving Levin's customer service at 203-846-6800, or you can email us at info@levinassociates.com. Listeners can also enter their questions in the Q&A box at the bottom of their Zoom screen at any point during the webinar, and as I mentioned, we'll do our best to address them in the time allotted. The slides for today's webinar, I believe, were just posted in the chat feature in Zoom, but you can feel free to email Levin's customer service afterwards to get the attachment. And finally, at the end of the webinar, a survey will appear. Your responses are greatly appreciated, and we use them to improve our future broadcasts, but also to inform our future topics. So if you have any suggestions, we are all ears, especially as we plan our final touches to our 2024 webinar calendar. So thank you for your responses. I also want to thank today's webinar sponsor, JLL Value and Risk Advisory, which brings together a team of 2,500 experts who partner with investors and lenders to identify, mitigate, and monitor risk, while optimizing real estate values across all sectors and geographies. So thank you to them. And I also want to thank Brian Lockard of JLL for joining our panel today. Brian also helped put together the panel, so I really appreciate his time on that. And Brian's an executive managing director, specializing in the seniors housing and healthcare sectors, very appropriate for today. He has experience in valuation, market studies, and feasibility analyses of single asset to large portfolio transactions in the US. And he's bringing that wealth of knowledge to the panel. So it's great to have you on, Brian.
Thanks, Ben.
Next, we have one of the more active brokers in the business right now. It's Jason Punzel of Senior Living Investment Brokerage. I'm used to getting an email from Jason. It seems about every other week or every week all year long with another closing. And since joining SLIB in 2013, he's closed over $500 million in senior living transactions. I'm sure that's even higher after the year he's had. So congrats. Congrats on another year, Jason.
Thanks,
and welcome.
Ben.
Our next panelist, I'd say, really deserves a round of applause because he's joining us from New Zealand very early in the morning there. That's Chris Hollister, co-founder, CEO, and chair of Pegasus Senior Living. Chris has been in the senior living business for over 30 years, serving in many roles, and he now runs more than 35 communities in 12 states at Pegasus. And thank you very much for joining us today, Chris.
Thank you. Pleasure to be here.
And finally, we have Austin Sacco, who's the managing director at Berkadia for seniors housing and healthcare, specializing in capitalizing the whole seniors housing and care spectrum. Prior to Berkadia, he spent about 9 years working at CBRE's National Senior Housing Debt and Structured Finance team, working with Aaron Will. And over the course of his career, Austin has been involved with the origination and closing of well over $10 billion in seniors housing debt. So Austin, I suspect a fair number of our audience questions may be directed to you on the debt market. So I hope you're on top of your game today.
Absolutely. Thanks, Ben.
We have our fantastic panel who will be covering the following topics. We'll touch on some M&A and valuation statistics to start, and our expectations for them in 2024. What will, or maybe what should, buying strategies be next year, and who will those buyers be? Next, the all-important, how will they pay for their acquisitions next year? So we'll cover the lending environment for bridge loans to agency takeouts. And finally, we'll cover what investors need to know about the operating world in 2024. And then we'll wrap up with some final thoughts. But quickly, just to set the stage for our discussion, this is where we are in terms of M&A activity in 2023. At a lower level than in 2022, certainly, especially on the average size of transaction. But it's not disastrously down from what many expected for the year, especially after how sharply and violently the capital market shifted at the end of 2022. And that's, M&A is not down as much because there are still sellers that need to sell, whether at the direction of their lender, their fund life, or because they can't sustain operating losses anymore. So they're certainly motivated to sell, usually at a discount right now. And of course, there are buyers who see that opportunity and they have the advantage at the negotiating table. So, Brian, our first question, with those basic market dynamics, plus the deterioration in margin at most communities and higher capital costs, we could go on for the other reasons. We saw the price per unit drop as an average across assisted living and independent living communities, sitting about 25 to 30% below their pre-pandemic highs. And we'll have much more of a complete analysis of the 2023 M&A market and the valuations in our senior care acquisition report, which we typically publish in February of the next year. But Brian, apples to apples, what do you see happening to per unit values for seniors housing properties in 2024 for A quality and then for B and C quality?
Yeah. First, I'd say it's a bit of a mixed bag, right? Like, to your point, folks aren't selling unless they have to sell. So I think the numbers that you're seeing here maybe are a little bit depressed from what we see on the valuation side. Our job as appraisers, we're really supposed to, hold a mirror to the market. And I agree, values are down, 10, 20, 25% even. But if you look at where the 10-year treasury is today, it's down to 3.9. So, that's trending in the right direction, albeit just a point in time. But, we did 2,500 appraisals last year. And I'd say it's a bit of apples and oranges, right? If you look at the Class A properties with good in-place cash flow, coastal locations, we're still seeing some properties that value at 350, 450, 550. Even some outliers at 750 a unit. So there are still really good margins out there, but the difference is there's just a bid-ask gap, and those properties aren't actually hitting the market. But when you look at Class B and Class C, I think that's where we're seeing some of these lower per unit values come into place. The long-term fundamentals are good. Rent increases are up. Occupancy is trending up. New construction starts are down, but we've got a debt problem and we have a financing problem for some of these underperforming assets. So I think these properties are trading more on a price per pound. I'd say anywhere from 50 to 100 per unit for Class C, all the way down to maybe 20 per unit if it's really tertiary. And then Class B is probably 100, 150 to 200 per unit. But it really just depends, right? And in 2024, I don't see this improving much and possibly softening a bit in 2024 as the market continues to adjust to where we are today.
Mm-hmm. And then
I think
go on, Jason.
I was going to say, I think 2024 is going to be really a bifurcated market for your stabilized Class A, even Class B properties, where value is really derived from NOI divided by a cap rate. I think the prices and price per units quite likely will go up a bit because NOI is in general across the country increasing. And depending on what happens with the 10-year treasury, if we can keep that stable, cap rates could actually go down a little. On the flip side, anything that is distressed, I think we're going to see a lot more of because I think lenders are going to force a lot more distressed sales. So the price per units on distressed assets, I think, will probably continue to go down throughout the year.
I'd certainly want to touch on cap rates today. So let's move on to those. They've been tough to measure in the last year just because of how few kind of de facto cap rate deals have actually closed in the last year. And also knowing what period of the rapidly changing financials to cap, that's also made it difficult. Brian, I believe you recently came out with a survey for cap rates. So I'll pose the next question to you. Where do you think cap rates currently stand for the different asset qualities? So Class A assisted living, stabilized Class B assisted living, and so on.
Yeah, sure. I'll start out, but I want to open it up after I get through kind of the results here to the panel, just to kind of get everybody's feedback. We did just complete our annual investor survey. We had 100 respondents, so thank you to everybody that participated. It ran over the past 3 or 4 weeks, so the 10-year was cooperating during that time. Just going down the list, Class A assisted living, 7 to 7.5. Class B assisted living, 7.75 to 8.25. Class A independent living, 6.5 to 7, and Class B independent living, 7 to 7.5. And then Jason, if you want to kind of opine on what you guys have seen, if that seems realistic or maybe a bit aggressive with kind of the market still adjusting, or what's your thoughts on that?
Yeah, Brian. So independently of you, I went through some of the deals that we have that it has either recently closed, will close, or we're getting offers on. So pretty real-time data. I broke it out between tertiary and primary markets. So Class A, assisted living memory care, tertiary, we're seeing 8 to 8.5, primary 7 to 7.75. So pretty close to what you're seeing, Brian. Class B tertiary, 8 to 9%, or 9% plus, depending on how tertiary. And then Class B primary, 7.5 to 8.5. Independent living, really very close to what you were talking about. Tertiary independent living, probably 6.5 to 7.25, 7.5. And then primary independent living, 6 to 6.5. So I think your survey is pretty dead on.
Yeah, I'd say, the one thing that I always say is you need to understand, what are you capping, right? And is it a cap rate deal, and understand the risk to that cash flow. If it's an underperforming property, I mean, it could be 100, 200, 300 basis points higher than those indications. But if you've got good in-place cash flow, I think that's pretty close to making a lot of sense there.
Well, and what can vary at 25 or 50 basis points is, are we capping T3 annualized, T12, year
Yep.
one? So that can certainly can change things a bit.
Agree.
Austin?
Austin, Chris, anything to add?
It's interesting, right? Because if you take a step back from this moment in time, and certainly we've seen some cap rate expansion, relatively material cap rate expansion throughout this year. So much of that being driven by financing or lack thereof, right? And what exactly the profile of deal is. And so it's very much been where are we as of late? Deals that have closed throughout the year were perhaps 6 to 12 months old in terms of actually going, under PSA and working towards closing. So things change a lot. And so I think it is prudent to note that as a sector, we've remained relatively disciplined with cap rates, right? We didn't see the intense we haven't seen intense expansion historically over the last cycle. We didn't get crazy with our cap rate compression like other asset classes did, particularly rolling through COVID in certain markets. So I think we will settle back into whatever that new normal is once we're in a more regulated, normal capital markets environment, right? Where you can look at the debt and say, okay, I have conviction in what I'm underwriting. There may be some slight movement throughout the process, but not the swings we've seen throughout this year. And so, citing ranges, it feels about right. Brian and Jason, what you guys have been citing, I would say maybe slightly more aggressive than what I've seen throughout this year, or even particularly the last 3 or 4 months, leading into the end of this year. But I think what it signals is general optimism across the industry, and how folks are thinking about these transactions from a true cap rate perspective versus a lot of price per unit that we've seen throughout this year.
From
an operator's,
go on, Chris.
Yeah, go ahead. Yeah, from an operator standpoint, I just cap rate implies just from a theoretical standpoint a stable NOI, and I think the operations are healing and getting better. But in my own company,
just to be frank, and I know other operators, it's got to be a harder operating environment. I do think it's getting better in some ways and easier, but I think for the capital providers, you have to be really careful to look at the tenure of the team, how people are doing assessments, how they're staying on top of those assessments, because everything is moving faster and things that used to be easier are hard. And staying on top of the staffing and the making sure you're getting paid for what you do is harder than it's ever been. And I agree with the bifurcation comment. I think there's a lot of broken deals that got to get kind of worked through the system in 24, and hopefully, I think by the time we get to 25, we're going to be in a more stable environment, both from a funding standpoint and from operations.
And Chris, do you think that cap rates where they potentially stand today, based on the ranges we've thrown out there, do you think they are correctly accounting for the operating and financial risk in today's operating environment?
Well, yeah, that's a good question. I think we're lucky to have cap rates where they are, given the chaos and problems we've had on the operating front in the sector. But there is a huge opportunity here. I think people keep thinking the baby boom is a hockey stick, and I don't really think it is. I think it's an incline, but we will have rising demand. I just don't want to say anything that will be perceived as good news, because I think we've needed a slowdown in development to let the markets and the supply demand imbalance catch up to reality. And I think we've suffered for a number of years here, really, from a sense of sort of irrational exuberance, particularly in sort of easy to build, low barrier to entry Sunbelt suburban markets where everybody sees the same opportunity with, I'll make this an adult child deal. And then you have, 20 new communities in the suburbs of pick a city, Dallas, Houston, wherever. But yeah, I think the opportunity is very strong midterm. I think 24 is going to be a year of a lot of workout. So I mean, just the other guys on the panel are closer to it than I am, but we just are seeing a marked increase in the number of transactions coming across our email to look at.
Mm-hmm. Yeah, I mean, Chris, I'll direct this next question to you first, but everyone else definitely feel free to comment on it. But if the industry is experiencing some kind of fundamental valuation reset, we've talked about per unit prices likely staying low and cap rates, are still sustained at higher levels. Are there any potential benefits to the industry in the short term if it's experiencing a valuation reset?
I think the benefit to operators is just, our portfolio is mostly older communities, and Welltower is our partner, and they've been great about upgrading these. So a lot of them I think are on a par with A properties or maybe B plus. I mean, they're older, but they've been fully renovated. But still, we've been plagued with new shiny pennies down the street, and I think having a time to heal here and let the demand catch up with the supply and have some of these things be repurposed that were not well designed. I mean, that's happening a lot. If you talk to people doing that, I don't think people are fully factoring that in. How many deals are just going to go away? They're going to go to behavioral health or multifamily, some of these things that aren't working. And I think the benefit is just to have a slowdown in development and let things catch up is a big benefit for operators.
Anyone else have a comment on the potential benefits of a valuation reset?
I'll chime in. I mean, I think a reset can help with the middle market. Affordability is going to be a big component going forward, and if we're resetting some of these properties to a lower financial burden, I think it will really help solve for some of that.
Totally agree. And Jason, with the expected changes in valuations next year, who do you expect the sellers to be? And do you expect to see a different seller profile in 2024 versus 2023?
Yeah, that's a good question, Ben. This year, so far this year as a company, we've closed 68 or 69 transactions. We should end just above 70. And so we have a pretty good wide range of sellers. From the non-stabilized properties, I'd say most of the sellers this year have been institutional groups cleaning up their portfolios. and then mom and pops who have just wanted to get out completely. I think next year it'll be similar, but probably a lot more lenders on the non-stabilized distress side. And then this year, from a stabilized standpoint, the sellers have been mostly regional owner operators that developed the property, did a really good job of leasing it up. It's stabilized. They're selling it to recapitalize other properties or build other properties. I think that's probably going to be this similar again next year. So I guess the only real difference next year, I think, from a seller's perspective, is there'll be more lenders involved.
Yeah, I guess if we saw a few more comps out there of some stabilized assets selling at particularly low cap rates or particularly high per unit prices, that could tempt a few more of the institutional sellers to get out there and build up their dry powder for 2024 and 2025. But I think we have to see a few more of those for that to kind of reset.
I would agree.
Mm-hmm. And what about the buyers? Potential change in the typical buyer profile in 2024. Who wants to take that first?
Well, I'm happy to take it again. I think hope, and it's kind of alluding to what you said earlier, Ben, is that I'd love to see more of the REITs and institutional groups get back in on the stabilized properties, and maybe that'll happen. I hope it happens. Last year and this year, I would say the buyers for the non-stabilized properties have almost been exclusively regional owner operators that have good relationships with local regional banks, credit unions. They're willing to do some type of personal guarantee. And I think those regional owner operators 3 years from now are going to be very, very happy that they bought the properties when they did, because they're going to be worth significantly more. As far as who the buyers have been on the stabilized properties, it's kind of been a mix. A few institutional groups, family offices, some smaller private equity groups, pretty much anyone that wants to get a low to mid-teens return on a pretty decent quality A minus asset today.
Mm-hmm. And what about the REITs? And anyone besides Welltower come to mind as someone who'll be a little more aggressive as a buyer next year, perhaps?
Hopefully all of them. I don't want to say any names just because I'll be getting a call afterwards. So, but I think in general, if we see the 10-year treasury continue to drop, it's going to lower the cost of capital across the board for every REIT. Whether you're borrowing money or not, your cost of capital is going to be lower, which allows them to buy more because acquisitions will be accretive instead of not.
Mm-hmm.
I'd agree. I don't want to name any names either, but we've done some work for some REITs that are starting to get active, right? They've spent the last couple of years largely trimming their portfolio, waiting for this opportunity, and I think 2024 is it. Looking at it glass half full, I'd really like to see the private equity guys get back involved. I think they've been on a wait and see approach. I think there's a lot of dry powder out there, and hopefully 24 is the start of that, of kind of the market reset.
Mm-hmm. That was gonna be my next question: can we expect any kind of significant outsiders coming back into the industry in 24, or do you think they could wait for 25? I guess we'll have to wait and see.
Yeah, I mean, we always see apartment groups nibbling at active adult and independent living. I don't know. We may see a few more of them slowly get back in.
Will active adult M&A come back in 2024?
I don't know. I hope so.
I mean, a lot of that comes down to where interest rates will be as well, just for how.
Depends on if we keep this trend up. And if it holds stable, I think to Austin's point earlier, it's just been so volatile that it's tough to predict.
Yeah.
Once the interest rate started going above the cap rate, it kind of blows up any opportunity to sell properties, and that was, multifamily and active adult.
Mm-hmm.
Which is why our industry still has sold a lot of properties this year compared to the apartment world, where it's down far more than it is for us.
Mhm. All right. Well, I mean, speaking of predicting, that kind of takes me to my next question, but also to our next to our poll question, our first poll question for the audience. So this will be the same question I direct to our panelists. But if you were an investor in 2024, what asset type / quality would you purchase? And you can only choose one here. So taking everything into account, the price you'd likely have to pay, the decent turnout opportunity, the likelihood of turning around, and the expected return that you would get from this. Taking all that into account, would you choose Class A stabilized AL, Class A non-stabilized AL, and Class B stabilized AL, Class B non-stabilized AL, and then I just did Class A IL, Class B IL. So, Chris, if you're an investor in 2024, which of these asset types would you purchase?
I would purchase Class B non-stabilized assisted living.
And why?
Because I think as an operator, hopefully we can perceive value and understand why it's broken. You always have to avoid hubris of thinking you can fix something. A lot of things are broken for a reason. But if you can look, do the due diligence and really understand, maybe they had a broken culture, maybe the ED and the team is unstable. It's in a good location. It's in a growing market. There's a way to add value with the real estate and get it up to sort of a B plus A minus property. Those are the kind of things we'd like. Now, I if it's 20% occupied or it's just so broken, we wouldn't want to touch it. But if it's 60-70% occupied, and we think we understand how to add value, we think that's the highest value opportunity.
Yeah, I'd agree with that. I think there's a real opportunity there for some of those need-driven product. I can tell you when I'm looking at something, I ask, is it market, is it building, or is it management? And if there's an opportunity to get in and turn it around for a need-driven product, I think the fundamentals are there that if you can solve the problem, your returns will be very lucrative.
Mm-hmm. Anyone else want to take a stab at that? If you're an investor in 2024?
Well, if I had the capital stack lined up, definitely either Class B or Class A non-stabilized, because I think we're going to see, we have seen and probably will continue to see for a little while longer, price per units that we're not going to see again for a long time.
Mm-hmm.
Agreed. Yeah. Agree with that, Dave. So very market driven. You have folks who are circling those core markets that have been a strategic play. That maybe some opportunities will break loose in 2024. Think 3 to 5 year entitlement where you don't necessarily have to wait. So I think there's a lot of compelling cases to be made. Class A, Class B, stabilized, non-stabilized. I mean, it's very market dependent and investor dependent, based on yields they're seeking. But I think you can expect to see some opportunities for investors to get into certain markets that have maybe been circled for quite a while for a pretty strong basis. And I think we all know here that a lot of folks have been on the sideline this year, kind of waiting for those opportunities to break free. And so kind of Brian's prior comments about that, I think we are going to see a lot more of that stuff start to break loose and already have, frankly, come into market. Expect to see a lot more next year.
Yeah, I'd really like to say all the above if I could. I know it's not an option here, but I just think the fundamentals long term for the industry are going to be there and going to be very strong when we come out of this.
Just more feasibility studies for you, Brian, if you're doing all asset types. So let's get the poll results up. All right, it is pretty evenly spread, but mostly centering around the assisted living assets. So the plurality was Class A non-stabilized AL. All right, that makes sense. But then that's at 28%. At 23% is Class B non-stabilized AL. All right, so those are the two most popular. And then Class A stabilized, the two stabilized AL categories both garnered about 15% of the vote, and IL was smaller. All right, pretty even spread across the board. So I was wondering if one particular category got 50% of the vote, then would more active bidding environments push up values for that particular category, but not sure that would happen. What do you think, Jason, about kind of bidding environments next year?
I think it'll slowly improve throughout the year. And it's so hard to guess because, you know, keep talking about the 10-year treasury, but if you go back 7 weeks ago, we're at Nick, it's at 5%, and everyone's saying, you better get used to high rates. They're here to stay. And well, now 7 weeks later, it's dropped 110 basis points. And the Fed yesterday, for the first time in years, have said, oh, we're actually going to cut rates. So, and we were talking about this before we started. The challenge as a buyer is you're going to put in an LOI today and the 10 years at 3.9%. And then you're going to wait to see if your offer gets accepted, then negotiate a PSA, then go through due diligence. So that could be 3 months before you're going hard on your money. You don't really know what kind of interest rate you're going to get when you're making that offer. So it's great that it's down, but as we talked about as a panel earlier, it needs to stay steady so buyers can have confidence in what they're doing and what they're bidding and not just taking a guess. So if that happens, if we see steadiness and lenders can, and then we talk to lenders all the time, and I do think lenders are going to slowly start getting more aggressive, not aggressive, just more than they are today. Yeah, we could certainly see a lot more offers coming in on properties. I don't think that's a January thing, though. I think it's probably mid next year.
Okay. All right. Well, let's shift gears to the lending environment then. So Austin, what will it take to have the banks return to the senior care market like they were before?
Sure, like they were before. Yeah, that's a really good question, Ben, and not so black and white. I think they will continue to be hamstrung by the regulatory environment leading into next year. You see so many being kind of pushed away from their overall CRE exposure within their portfolios. I wouldn't say 2024 feels like they will be aggressively pursuing growth. That being said, banks have lent throughout this year, largely consisting of regional and local banks, by and large for clients whom they have strong relationships with as well. But I think it needs to be said, ample bank liquidity in our sector is vital to the health. And they've provided so much. We're short on insurers relative to other asset classes. You really your main stops are your banks, your debt funds, a handful of insurers, and really the agencies. And so, when you take a look at how much they've propped up our sector, construction starts this year have been down substantially. Pipelines are being picked up for next year. Involved with a lot of that personally as well. So it is vital that they do make their way back as best they can to our sector, while obviously managing what they have to from a regulatory standpoint. So there are folks out there lending today, plenty of them, albeit at tighter lending standards, requiring higher coverage limits to qualify for loans and using those governors that weren't there previously, and in addition to depository relationships and other things of that nature that you haven't historically seen throughout the last cycle. And so, obviously, when you're looking at SOFR and you're looking at the treasuries, any downward pressure, there and the overall health and state of the capital markets that gives comfort from a regulatory standpoint, I think you'll see them start to push back in. But it's going to be very, very interesting next year with the anticipated increase in acquisition M&A activity paired with new construction pipelines starting to work their way back. It's certainly imperative that they try and make their way back
in. Let me just throw out a hypothetical for you. Let's just say that the 10-year treasury hovered between 3.5 and 4 for the first 6 months of next year. What kind of spreads could borrowers expect to get for a bridge acquisition loan? And then if there's that kind of stability at this relatively lower level in the 10-year treasury, what will that do to the lending environment, liquidity in the market?
It's a good question. I don't think we're going to see much movement in loan spreads. Certainly there's been some expansion throughout this year, whether it be banks, whether it be debt funds, mortgage REITs, private credit lenders, whomever in the sector. I think obviously the underlying indices being SOFR and Treasury coming down certainly helps your all-in interest rate coupon. But as far as banks and bridge lenders are concerned, I think you'll see essentially the same lending standards they've had throughout this year and the requirements they have for you to, take on those transactions. But obviously any reduction in your all-in interest rate is a very positive thing, because they've been so high throughout the duration of this year. So it'll be interesting to see. I'm not sure from kind of the quantitative and qualitative parts of the loan, you're going to see much movement kind of back to what we saw pre-pandemic kind of levels. And so it'll certainly be an interesting case study. It's a challenging question to answer because really lending institution to lending institution, everyone has their own thesis and how they're going about it. So it hasn't really been a binary thing. Everyone's kind of moving at their own speed. So it'll certainly be interesting to see.
And sorry, one more just rapid fire to you, Austin, that's off our Q&A. What's more important, stability or lower, albeit more volatile movements in the interest rates?
Stability, certainly. It'll be interesting to see what the new normal is. I'm not sure anyone on this panel or anyone tuned in believes that we'll reach debt costs, the interest rates that we saw, pre-pandemic, perhaps once in a lifetime. But I think the question begs, what is that new floor, or I guess range, going to be, and where will we settle in? And what we found, particularly with the volatility this year, is it makes investors very, very uncomfortable when you're trying to underwrite a transaction and have any level of conviction, that you're going down the right path there. So I would certainly say stability, something you can underwrite, particularly on a stabilized side, durable cash flow streams, everything that goes along with it. Same concept as underwriting a deal. That constant stability, I think, is very, very valuable as folks are trying to wrap their head around where valuations need to be and what deals make sense.
And one more question, but it's for the audience, although all of you can chime in if you want. Let's get our second poll question up. So does the 10-year Treasury dropping below 4% and the Fed's plan for 3 rate cuts change your M&A plans in 2024? Just yes, no, or let's talk at 3.5%. Anyone have an answer there? I guess, prelude it for about 10 seconds so it doesn't inform half our vote. Who wants to take that?
Yeah, it probably helps. It probably increases people's acquisition appetite, compared to what it was 8 weeks ago at Nick. It can't do anything but help it. I think, but to what Austin said earlier, it's definitely about stability and consistency more than it is just lowering of the rates.
Yeah, I mean the difference in mood. The mood at Nick was certainly sour.
I was going to say, not the best Nick ever.
To put it mildly.
It'd be fun to do a Nick today and see what the mood is compared to what it was 2 months ago.
Yeah, and I'll try not to make too much of it. Just we'll see where it shakes out in a couple weeks from now. But Brian, how about this next question to you? What do we expect in terms of distress or default driven deals in 2024? It's kind of been touched on a little bit before, but what are your thoughts?
Yeah, I mean, I think I agree with everyone's comments on it already. We've seen just the tail end of distress in 2023, in my opinion. From our standpoint, we just started doing evaluations for kind of gut checks, and kind of the refis. The banks are checking. What do we have? And I think it's come down to, the olive branch can't and won't continue to be extended in 2024. We've got 16 billion in loan maturities coming over the next 24 months. So I think that alone is really going to drive deal activity and help reset the market.
All right. So let's see the results of the poll. Oh, pretty even spread again. 40% say yes, it will change their M&A plans in 2024. 30% say no, and then 30% say let's talk at 3.5%. All right, interesting. That's across 60 votes as well. So, all right. Well, we just got an audience question, and Chris, I'll direct this one to you. What this is from James Scribner. Good to see you, James, or hear from you. What has a bigger impact on M&A, interest rates or wages and labor?
That's I think it's pretty equally weighted, right? I mean, you can't. The difficult thing about being an investor in any real estate or income producing properties, you don't know what your exit is in 5 years. So if rates are going to move 200 basis points, it doesn't matter with wages and salaries and what happens with that, because it's going to be very hard to make money. So, I know Kurt Reed says you cannot, one of his sayings, if he's listening, I hope he is you cannot recover from too high a basis. So you got to have the right entry point, and that insulates you from that. So I think if rates do drop down more into historic norms, that's going to protect you from that potential. And then the wages and salaries becomes critical. But I think a lot of the nomenclature and how we think about this is all derived from the real estate industry, and even class A, class B. I think people really need to think of it as a matrix of sort of real estate market and management, and rate all three of those. And I don't really know what class A means. I think one of the big problems we've had is people overbuilding the real estate and still looking at 75 plus as a demographic for AL when everybody operating knows it's 85 plus. Well, that shrinks the demand by 60%. And in general, I think the people who have had the most trouble in what we're looking at with these workouts is people who have overbuilt the real estate. They've tried to win with real estate, and this industry is more related to something like buying a restaurant. Well, why is that restaurant great? Well, they have a great chef, they have great service. It's the real estate and the vibe is important, but the service piece is critical. And if you're going to be entering the space, you really need to try to line up all three of those and think of this whole AB thing as a matrix. And I know I went off the reservation on the answer, but I think it's an important point to consider when people are evaluating opportunities.
Yeah. No, I'm glad you made that point. Oh, and we just got another audience question. Which is more important, a class A property in an A location or a class A operator?
Like being an operator, I'd
depends.
say class A operator.
Yeah. Yes, I'd say the same thing.
Agreed.
We see it all the time where you have a great building in a great location that's not doing well, and you're like, so.
Yeah, I think this industry it's about the people, and the operator is the best part of that component, and without one, we've seen it time and time again.
Well, it just ties into the overall theme of our industry, right? Which care drives all. And so you can have the nicest building at Main and Main, two different operators in there, operating 20% delta in their overall margin, 25% delta just based on who they are, exposure to the market, all that good stuff. So, we're tied into the real estate side so heavily right now, given what's going on in the capital markets environment. But obviously the care provided by operators and is what drives our sector and props it up, and what makes it so special, and ultimately leads to those higher valuations that everyone in our sector loves, right? So I would say operator every single time.
Yeah, we've seen in our evaluations, same buildings, class A buildings, but you look at them with the operators, one has that perfect operator in there, and the margin's just totally different, and the price per unit obviously it's extremely different.
Well, and what I would say in humility as an operator is it's not just the operator, it's the specific people running that building
Mhm.
because I think I'm a good operator, but as Welltower would tell you, we have buildings we've had a lot of success. We've had some that have been extremely challenging, and for reasons that we're still trying to understand. And I think the biggest challenge we have as operators is finding talent. There's a limited number of people that have experience doing this, and a lot of them are quite traumatized from COVID. And I think we really need a whole new approach of getting.
Oh, is
I
Chris?
think we lost Chris.
Chris, we lost you for a second. All right. We'll wait for Chris to come
Very
back.
Successful.
Chris, we lost you for a second.
Oh, I'm sorry. Sorry about that. I was just saying, I think we need new talent in the sector, need to start looking outside of the normal group that we're getting. We have a lot of great operators in our company. It's just a limited pool. And I made the point, if you didn't hear me, Dwayne Clark's talk from SLIF. Look at that if you can, because Dwayne and Aegis are obviously one of the most successful companies, and they hire mainly outside the sector and bring people in and train them to run assisted living. And I think it's something we have to start doing because there's just a limited pool right now of people who can actually run these buildings. So it's not just the operator, it's the specific people running that building, because that's a lot of your value creation and value maintenance is the people running the building. And I don't think there's been enough attention paid to that.
Great. Austin, the next question to you. What can we expect in terms of lending activity from Fannie and Freddie next year?
I think you could expect to see increased lending activity from them. This year, by and large, were refinances. And there were a number of acquisitions that they lent on, but by and large, refinances. I think with the anticipation of the M&A market picking up next year and the continued push to more normalized NOI margins, I think it's going to drive more eligibility within Fannie and Freddie. And it just gives a little bit more certainty, right? If you're looking at an agency loan today, plus or minus a 200 basis point spread over a 3.9, you're sub 6%, right? You're touching the fives again on your all-in interest rate. There's heavy focus on market sponsors that come from their end, right? In underwriting standards, certainly. But that being said, I think this year, combined, they're going to be less than $2 billion in volume. Again, from the fall off in the M&A, side, I think is largely driving that number. So my expectation is there's certainly going to be more Fannie and Freddie activity kind of fueled by the M&A market, in addition to, pending refis coming down the line as well. And then, assets that have maybe kind of bumped along for the last couple of years that you're going to see, start to qualify that we really haven't over the last 24-month period. So I would certainly expect more.
Is there any worry about any kind of distress on their books, much like a lot of lenders out there? Any non-performing assets?
I'm not sure there's a lender out there who has 100% hit rate, in their portfolio. And so, yes, certainly there are concerns, across the spectrum, not specific to just the GSEs. And but as far as a larger underlying problem that's going to cause anyone to pull back or out of the industry, I certainly I wouldn't expect to see anything like that. But to Brian's earlier point, touching on distress, it certainly forms a need to work through some of those troubled assets the best way that they can. But I wouldn't expect it to make a material impact to their day-to-day, business and providing liquidity. They've always historically, provided the lion's share of the permanent market. Again, kind of going back to the lack of insurers and other avenues that folks have in other asset classes. And tying back to the bank comment, just as it's important to have the banks in our sector, it's extremely important to have the GSEs, lending within our sector as well. They provide a ton of liquidity.
And a pullback from them, if were to happen would have much more of an impact on on the industry as well. So
Absolutely.
hopefully
Yes.
hopefully that does not happen. All right, and another one to you, Austin. What should borrowers be looking for in a permanent refinance in 2024 in terms of rate, terms? What can they expect in 2024?
Sure. From a permanent refi, we'll just stick with the agencies. I mean, the most popular over the last cycle and into today have been the 7 and 10-year product, fixed and floating. We saw an uptick in demand for a 5-year paper from Fannie and Freddie at the beginning of this year. For a variety of reasons. There was some flexible prepayment and other things like that that folks could match up with fund maturities that had extension options that were running out, things like that. We're not seeing as much on the 5-year paper side. It really continues to be the 7 and 10-year fixed and floating. Obviously since Halloween, we've dropped over 100 basis points on the 10-year treasury. Since Thanksgiving, we've dropped 50 basis points. And so it's hard to sit here and say in June of 2024, you're going to be at a 5.5 all-in rate, with 5 years of interest only. But by and large, I think you can expect kind of similar economics to what we've seen this year. I think you're going to see reduced LTVs based on, NIC, Metro, markets, how they're viewing that market, specific sponsor experience with that sponsor, real estate schedules, how folks are performing outside of that asset. Everything, all of those little pieces go into what your ultimate economics look like on specific assets and loans. But it's wonderful timing to have this call today where I can sit here and say with a straight face that you'd be likely sub 6% all in today on your 10-year fixed rate coupon if you were to lock that in. It's a hard question to answer because it does move around, but if we stayed in this range, kind of cost of capital range, I think a lot of folks could make plenty of deals work from a positive leverage perspective on some of these agency loans.
And kind of a follow-up for Jason and Brian, if you want to take this, how are Brian in your appraisals and Jason when you're dealing with sellers and buyers, how are the buyers kind of valuing properties in terms of an agency takeout? Like what are they expecting down the line to take out their bridge debt?
Wow, Fannie Freddie HUD. I think we were talking to a very large bridge lender just a couple days ago, and they were talking about increasing their bridge pool of money for next year. And that's the other piece of getting deals done, especially on the HUD side, is you're not going to go directly to HUD on a purchase. You got to get a bridge. A lot of the bridge lenders were not very active this year for a variety of reasons. So if we can see that activity pick up, I think that would be very beneficial as well.
Yeah, I'd agree. I think Fannie Freddie HUD, that's the ultimate goal, and really their mission is to provide liquidity to the market. And we saw, they've each had their problems. I think it's been, somewhat known, and I think 2023 was really working through that. And 2024, I expect that appetite to pick up for financing, which will be good for the market and good for buyers and sellers.
Mm-hmm. And Chris, I want to turn to operations for a moment. So in your opinion, in the operating environment, what will still be the biggest problem operators will face in 2024? Is it still staffing, or is it on the expense side? Is it something that I have not mentioned yet?
I think it is staffing, but what I would focus on the staffing is leadership. COVID was really sort of two elephants in the room. It was COVID, and then right behind it was the labor crisis elephant. We've largely gotten agency out of the company, and I think a lot of my colleagues have as well. But it's more about getting stability in the leadership team. And I just go back to the point I made when I was getting cut off. I think nothing against we have a lot of great operators, but I think we need new talent, need to broaden the funnel and have programs. Operators need to have programs where they're training people to be an executive director. And, it's out there, but am I breaking up again?
Yeah, you're okay for now.
You're great.
Sorry. So, we have to just broaden we need more stability in our management teams. That's how I would say that's our number one challenge.
And what about wages? Perhaps we won't see as large of increases in 2024, but do you see wages across all levels of staff still going up at a perhaps a higher pace
I
than in
think it's
previous
actually
years?
flat. I think it's flattening out from last year, except in California, where they're going to, with the
Mhm.
mandated wage pressures out there, you're going to see quite a bit of wage pressure in California. But look, I think most consumers can't really pay for assisted living now anyway. They're selling the house, or the three siblings are putting money in. People will pay for quality care, but you got to deliver quality care. So you need to pay your people to where you are staffed appropriately. And most people don't quit a job, they quit a boss. So the more we can have better leaders in these buildings, that's the number one way to fix the turnover problem. I say the turnover problem is bigger than the wage pressure problem now. The wage pressure was huge last year, and we still have to look at rate increases that in 24 to cover, wage pressure of, 6-7% perhaps, but it's not double digit except perhaps in California.
And without giving up, all the secret sauce, maybe what are a couple of things that you're aware of at Pegasus to try to find those great leaders, but also improve your retention?
I think people want leaders in the C-suite that they know are in it for the right reasons. We do a lot of things, corporate events, took everybody to Park City this summer, make it fun, try to support them. I do think we need to look at compensation. We have at Pegasus. I think the whole industry needs to look at how hard the executive director position is and how hard the health and wellness director position is, and look seriously at increasing that compensation. It's just going to cost more because these people deserve it. And then give them a greater share of the pie, particularly if it's a non-stable situation. Say, look, you lease this up, we will give you a big bonus when you fix it, because they are the ones driving it. Again, and back to comparable to a restaurant. If you don't have a chef who's on his or her game or in there in the kitchen, if you don't have a front of house, you're not going to be successful. It's the same thing. It's a very micro level thing. These are not commodities. These are all individual situations that have to be managed in a very precise way.
So just one follow-up to that, with wages, with being a little more cognizant of what we pay the employees of all levels, but especially of the executives, the leadership, do you see margins permanently perhaps 5-10% lower than what they were pre-pandemic as a result, or do you see it stabilizing?
I think it could go up. I think margin's a weird concept, okay? Because a margin is a ratio. And I think it's much more helpful to talk about NOI per unit. I would urge everyone listening, if you're looking in the sector, look at NOI per unit, because your margin can go down while your NOI per unit goes up. That's why nursing homes have lower margins but higher revenue per unit, because they're doing more. And we're going to be doing more because acuity is going up. People are coming to us later and having more complex needs that are changing more often. So that's the whole thing, staying on top of that. But, I think that, we could see margins per unit go up. They should go up because we're doing more care. The margin percentage may not go up, but the NOI per occupied unit per month should and can go up. And we have a lot of buildings that are above pre-pandemic right now. Not a lot. I want to caveat that, but we have some that are fully recovered and above where they were before the pandemic.
Your point on NOI per unit is certainly taken. There's a section of our acquisition report every year that when we get to NOI per unit as an average for the previous year's market, we typically will say,
well, I mean,
you can almost disregard the previous pages. I mean, not entirely, but it's
yeah. I mean, you don't need a
important.
percentage. You don't pay with a percentage. You pay with a dollar sign.
Mhm.
So you look at percentages, you're going to be confusing yourself all the time. It's really how much you're making per person per month, and that helps the team think of, well, why that what you're talking about is actually going to add $100 a unit. Well, that's a huge number. You have to break them down that way. I think is very helpful.
All right. Well, we've made it to our last question, and we're just after 2 p.m. So I'll go down the line here and ask this question to everyone. But one could say the theme of the 2022 and largely the 2023 market is perhaps the year of the mom and pop exit. That's one way to put it. There's other options for if you're thinking of a sort of yearbook superlative for the year. So I just want to go down the line and get you guys to kind of give us your projected 2024 theme of the M&A market. Brian, do you want to go first?
Sure. Thinking superlative, I'm going to go most changed. And I'll say that, I think we're going to come out of this much different than we are today. Technology advancement, staffing, whatever it may be, and with improved fundamentals. And I think with both that combined, we'll be at a better place for long-term success.
I like that one. Austin, you want to go?
I'll go with most attractive yearbook superlative, because I think there are going to be some substantial buying opportunities. Again, kind of going back to earlier that folks have been earmarking in certain markets and regions, and I still think that the all-in basis on some of that is going to certainly be better, than they would have ever originally envisioned. So I'm gonna go with most attractive for next year for that reason.
Very, very positive group so far. Chris, what about you?
I'm stealing it from a thing I heard at Nick, but I think it's the theme for 24 is survive to 25. I think it's going to be a chaotic year on the workout front. I think hopefully with rates what we've seen in the last 2 months will continue, and I think there'll be people in 5 years will say, yeah, that was an incredible deal I did, akin to, the early 90s and the RTC days. Some of these, if you enter under $100,000 a unit on some of these things, you're going to be very happy in a few years. But I think I hope the irrational exuberance of what I would call the last few years doesn't come roaring back with people thinking this is a hockey stick of growth. Demand is going to increase, but it's a gentle hill. It's not a Everest, and it's going to take time to heal. And I think it could look a lot better in end of 24 and into 25 than it will in the first part of the year. And there's just a whole lot of workouts that need to happen. And we don't need a whole lot of new development. I mean, I hope that's not here comes the steamroller development train again, because in markets I'm in, there's still plenty of empty units. Dallas, Houston, Denver, Phoenix, Atlanta. Please, if you're listening, I don't think it's a time to jump in with new development. Go buy something for 100, 200 grand a unit. Don't build it for 400 grand a unit.
That's a great point. You could almost take us back 10 years from today and all the new developers seeing the opportunity, and also citing the baby boomers as a reason to start building 10 years ago. We could see that on a whole new scale, potentially a year from now, more likely 2 years from now. But it's when development comes back, hopefully some lessons would have been learned from the last.
Yeah, exactly.
And Jason?
Mine will be the tale of two halves. I think the first half of the year will be very similar to 2023. I think the second half of the year in the M&A market could surprise some people as far as the velocity picking up as well as prices increasing.
Well, we have a couple minutes left. I'm gonna open it up to the floor. If any of you have kind of one parting thought that you think our audience should take away from this conversation going into 2024, what do you think they really have to know coming away from this?
I'll start. Our sector overall, the health of our sector since the pandemic has clearly gotten substantially better over time. It's a moment in time in the capital markets. that have rendered things very, very difficult. But I think the health and strength of our sector, and where we are overall, it's still certainly very bullish on it, and there's going to be a lot of successful years for a lot of folks running into this next cycle. And so stay the course and stay prudent in the investment decisions. But it's a wonderful asset class to be a part of, and we encourage everybody to continue working together as an industry in the right direction to get it all back on track.
Great. If anyone else
Sure.
has anything,
I think most of the assets that are going to be bought in 2024 are going to be worth a lot more in 2026 or 27. And that's easy for me to say. I'm not an operator like Chris, so I don't have to roll up my sleeves and do the real work. But I think the assets that have been bought this year and then again next year, people are going to be pretty happy with it a couple of years down the road.
yeah, it's certainly
Yeah.
an opportunity of a decade, perhaps.
Yeah, I'll date myself in and say, quote, Hill Street Blues, be careful out there. I think there are a lot of opportunity. There are a lot of opportunities out there, but some things are broken for a reason, and pay attention to the people. And frankly, just very simply pay attention to the walking distances. I see some of these newer buildings, and frankly, they're just with the acuity and assisted living. If all our buildings were 60 to 80 units of AL and 12 to 20 memory care, almost everything would be 100% full. Where we have problems is when things aren't sized right for the market. It's just harder to keep over 100 units full of assisted living when you have this level of acuity. I mean, you have 8 people die in a month. So don't be wowed by the real estate. Look at the people and make sure the walking distance is alone. Walk to the farthest unit and walk back to the dining room and think of yourself being 90-year-old with a walker. And can you do that 3 times a day? Because some of these buildings are obsolete from the day they were built with the acuity and assisted living that we have now.
So that's a great point to end on. Brian, just quickly, there was an audience question. Where can we obtain a copy of the survey of cap rates?
It's not released yet. That was a sneak peek, but it will be available in January. And I can certainly, you'll see it blasted all over. So look for that in beginning of 2024.
Nice. All right, great. Well, fantastic. Well, I want to thank all of our esteemed panelists for participating today. It's certainly not lost on me the time spent in preparation and, of course, deep thought to prepare for this on top of your day jobs. So it's greatly appreciated. I wish you all a successful 2024. Sounds like there's certainly a lot of optimism in the room. It's in a lot of ways it can't get worse than 2023. So there's that to consider. And I also want to thank today's sponsor, JLL Valuation Risk Advisory, and Brian for helping to put today's panel together. Great working with them, and hopefully we'll do again in the future. So I appreciate it, all of you. It was a great conversation, and we'll certainly stay in touch for next year's activity.
Thanks, Ben.
Thanks, Paul.
Thank you,
Happy
Ben.
holidays.
Thank you all.